And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The ETF business has grown by leaps and bounds by packaging plain vanilla indexes like the S&P 500 or the NASDAQ to investors, along with narrower slices of the market like cybersecurity, clean energy, cloud computing, and other thematic tech ideas. But now the ETF market is seeking to expand a little bit by offering narrower bets on individual stocks. So are you ready for a long and short ETF on Amazon? How about Apple? How about NVIDIA? Let's talk to two of the ETF leaders who are trying to make this happen. Dave Matza is the head of product at Direction, and Will Ryan is Granite Shares CEO, joining us to comment, as he often does, Dave Nautic, financial futurist at ETF Trends. Dave Matza, in February, Direction filed for 21 new ETFs, each offering exposure to the daily inverse or leverage returns of a single high-profile tech stock. I see NVIDIA, Meta, Netflix, Apple, Microsoft, Amazon, Google. Explain for viewers who are still a little fuzzy, how would this work?
Yeah, no, that's exactly right, Bob. So to be clear, these funds are not yet in the marketplace. They have been filed for. What they're intended to do is provide amplified exposure on individual securities, but they're structured in the same exact way that traditional leverage and ETFs are structured, meaning they provide a daily reset mechanism. So they're really intended for traders. So if someone does not have the ability to monitor their portfolio, to make a buy, sell, or hold decision on a daily basis, these, alongside other leverage ETFs, are not for them. But it's really a natural extension of the ETF marketplace. And as we've seen, as ETFs have entered into new spaces, they've tend to traders and investors have tended to look to them to provide solutions for them. And this is a solution for the trading crowd.
Yeah, Will, you've also filed for a similar series of leveraged and inverse ETFs, but you've already got some of these products operating in Europe. You have 3 times long and short Alphabet and Amazon and Apple, Facebook, Microsoft, and NVIDIA. Now, how do the products trade in Europe, and who's using them over there?
Yeah, so we have over 100 of these trading in all the major European markets and have been for the last 2.5 years. And I would say, having experience with these products over the number of years in my career, that it's a similar profile of investor, whether you're talking about Europe or whether you're talking about the U.S. What we call them sophisticated investors, but I think that means that it's somebody with good financial knowledge, somebody who trades a lot, who's very active in the market, and somebody who's comfortable with taking risk, and especially in a levered product like this. So I think that profile is something that is fairly consistent across the board. That doesn't mean to say that you don't get institutions that trade these products. Certainly we see a lot of those kind of investors. But I think the general feeling is that it's a sophisticated investor, in those markets.
Dave Nautic, I wonder how receptive the SEC is going to be to all this. You and I have talked about this before. We did a show on this a few weeks ago, these complex products. Gary Gensler has been wary specifically on leverage and inverse ETFs. Months ago, he said, I'm quoting, these products can pose risks even to sophisticated investors and can potentially create system-wide risk by operating in unanticipated ways when markets experience volatility or stress conditions. This is Gary Gensler speaking. And Dave, it seems to me there's a chance the SEC may turn these guys down.
Yeah, I think that's a reasonable guess. I mean, we've definitely seen a significant interest by regulators, by FINRA and the SEC on any products that don't necessarily make a lot of sense when you look at them right up front and you really have to dig in. And I think that these products definitely fit that bill. I'm not against these products. I think if we're going to let people, trade leverage volatility or any of those things, then these belong in the mix. But I do think that there's now a risk of some level of contagion on the ticker front. Try to imagine a world where we had the top 300 or 400 stocks.
I think we just lost Dave, but we're going to get back to him. Dave, can you pick up on that? I wonder if what real risk there is to these products. The biggest problem I consistently have explaining these products to investors is what you just talked about, this daily reset. If you don't have the ability to understand that, and it seems like a lot of people don't, because I've had to explain it for years when these products have had problems in the past, this is not a product for you. Is there some kind of systemic risk around this, like Dave was trying to get at right there?
Well, I think the biggest risk is that, to your point, is that someone uses these products and doesn't quite understand them. So prospectuses exist for a reason. As boring as that work may be, it's all spelled out how these products work. And it's just, at the end of the day, simple math. With that being said, you do have to recognize that they are not intended to be buy and hold investments. So if we look at the return of the S&P 500 and then SPXL, our 3-time full fund, over a month or even a week, it may not be the same because of the volatility and the compounding. But on a daily basis, minus expenses and operating fees for the fund, it's going to do that. So traders need to know how to use these particular products. Now, the idea that they cause systematic risk, or systemic risk, I should say, in the actual market itself, I think is a bit of a stretch. As you know, for years, everyone was pointing to ETFs increasing volatility, correlations. They're not going to work in fixed income. They're not going to work in commodities. I think we've seen that through many stress environments for many years in different scenarios. The ETF structure has proved to be resilient. But at the end of the day, we really advocate for traders to understand how these works, and particularly around, again, that daily reset mechanism.
Dave Naudig, we have him back. We were just talking about the problem with explaining the reset mechanism to investors who seem to get confused about this on a regular basis. You were going to make a point, I think, about if these proliferate, they might pose some kind of broader risk to the market. You want to finish your thought on that?
It's not so much that I think there's a systemic risk that the exposure is somehow going to put the market itself at risk. I do think there's a lot of opportunity for confusion. Imagine there being 6, 7, 8 different ETFs, all pegged, say, against Amazon. Now do that for all the securities in the S&P 500, and you've literally got thousands of Amazon and so on adjacent tickers. That's the piece that I think is a little confusing for most investors. I don't worry that these pose a systemic risk. I think that people might not understand them going into them sort of at the retail level. That's what I'm most worried about. Does the Robinhood investor understand, in a world where we've got 6 or 7 of these levered or inverse plays on every major security in the market? That's where it starts to get a little bit confusing to me.
Yeah, Will, you can understand what we're talking about. I'm the guy who has to go on TV and explain what's going on every time the leveraged, inverse or volatility product blows up, and I have to explain this is the daily reset. And after a while, Dave Naudig and I have joked for years, leverage and inverse products are 2% of the volume, and they're 98% of the problems when things get weird, and you have to explain them. I think that's the concern, and I disagree with Gensler on a lot of things, but he does have a point about the potential risk these products have. How do you respond to that?
Well, I think, going back to what is the risk, there are a number of different risks. As Dave Marza said, they're all really highlighted or disclosed in the prospectus. But clearly one major risk is that with using leverage, the returns are amplified, and therefore the potential losses can also be amplified. So when you talk about a product needing to close, the reason for that is because the move in the underlying market has been so much or so big that with the leverage on top of it, the fund loses its exposure, or the investor loses its money. But I think that's the really important thing, because with these products, you can't lose more than your initial investment. And that's unlike a lot of forms of leverage, where clearly the big risk is that you can lose more than your initial investment. And so with these products, when we talk about worst case scenarios, a lot of the time what make the headlines is when a particular fund, you talked about the volatility products, have to close, and that's because there's an underlying market move that, once you add on the leverage, is too big for the product to sustain. But the good news in my mind is that this is a safer way to do leverage than a lot of the traditional ways that investors are already doing in the market, whereby you can lose more than your initial investment.
Yeah. So just following up with that, Will, this seems to be a product ready-made for retail investors. You mentioned yourself active investors doing this over in Europe, but I wonder if the tide hasn't passed on this product. Schwab reported their earnings, and they said retail trading was down. It seemed that way with Robinhood as well. I'm wondering if the tide has peaked a bit for retail, and these products may not have as much appeal as they would have, say, even a year ago.
I think that it's too early to say whether the trend in retail investing is past. I think a lot of that would have to be the market environment that we've just been through in Q1. And so clearly that's taken some of the froth out of the sort of rabid appetite that people had for stocks, particularly in the last quarter when the market was going up parabolically. So I think some of that is just down to the market environment. But I don't think the trend of investing or more investors accessing the market is coming to an end. I think if anything, you're going to see more people accessing the market, more people wanting to participate in the stock market and the different forms of trading or products that are available to them. So for me, I think it's more about the market environment and less about the trend in retail or trading more broadly.
Yeah, Dave Nodick, chime in on this, on the retail investor.
Yeah.
I'm not saying it's peak retail, although it seems that way a little bit. We keep trying to make new products attractive to people who, for short-term investments. I had this problems with thematic tech ETFs. I happen to love the idea of a cybersecurity ETF, but you have to admit, if you're Jack Bogle, he's going to be wagging his finger at you and saying, you just got a shiny new object.
I mean, these are speculative vehicles, and that's what they'll be used for. And we've seen with the huge rise in the use of single stock options by retail investors, I'm sure that these products are going to be catnip for folks that are really looking to day trade around event risk in particular, earnings announcements, inclusions, what's going on in Twitter, all of those things. These are just catnip for those kinds of speculators. But what these aren't are portfolio building block tools. And I think we just need to be really clear about that. Both these gentlemen have been very clear about that. These are traders' tools. They should be used for short-term, event-specific trading, not for building up a portfolio of exposures. As long as investors stick to that, as long as, I should say, traders stick to that, then they won't be surprised here. My concern is that these are very, very sharp tools, and when people reach their hand in the drawer, they're not always looking as carefully as they should.
Yeah, I think that's what Gensler is trying to warn about. Dave, maybe you could enlighten us. What products attract the leverage and inverse crowd? The biggest product you've got is the SOXL, which is the semiconductor. This is leverage 3 times, right? That's your biggest product out there. There's over, I think, $3 billion in assets there. Is there a particular type of product and a particular type of investor that uses these more than anybody else?
Well, the main type of investor is really that trader. And by that, I mean someone who can monitor their portfolio on a daily basis. If we look at something called the implied holding period, so we calculate how long do folks actually own these funds, it's very, very short. So for the most part, folks are using them appropriately. They understand the daily reset mechanism. And if someone is looking for more information, I recommend taking a look at the material we have on our website to understand that. Now, the products that are being used, particularly this year, it's 3 camps, and it's probably not unlike what we're seeing with thematics or other. You have a risk-on camp, and so we're seeing on a daily basis money move in, particularly on down days, into the semiconductor space. So SOXL has, performance-wise, struggled, but investors or traders, I should say, have moved into that space, particularly on those down days. Then you have your rotate camp, and here we're beginning to see money flow into oil and gas. So a ticker is GUSH. This is a leveraged vehicle on the oil and gas space. And then you have a risk-off camp. So then there's just folks who are looking to hedge portfolios, particularly with earnings season, so that as opposed to maybe selling individual positions that they might have in the tech space or in the financial space, using an inverse ETF to provide that daily hedge for them if they think there's an event risk out there. So really kind of a diverse opportunity set that we're seeing, but really it's primarily concentrated with the trading community who are looking to make either that risk-on, risk-off, or rotate idea.
Yeah, the problem I have, Dave Nodick, is that you can do all the disclosure you want. These guys are all legally protected here because they've done all the disclosure, but that people don't read the disclosures and don't pay attention to it, and that's the problem I have. They don't understand what goes on with these, because I get the emails. You have to do this too. You have to explain it when this stuff blows up somehow, and then people write to us, wait, explain that to me again? It gets reset every day? What?
Well, this
happens
at the.
And they can't get their head around this.
Yeah, this happens at the face of the coal mine, right? This is where at the front end of your Schwab account, your Fidelity account, your TD account, many of them will put up, a quick note saying, by the way, you're trading something that's got leverage characteristics. Do you really understand what you're doing? I'm a big fan of that kind of positive attestation for more complex products. That's not exactly what FINRA is asking for in their recent request for comments, but something like that, I think, is inevitably going to come as we have proliferation of more and more complex products. I'm not against the products, but I do think enhanced disclosure and attestation is probably coming soon.
Dave Mazza, can you update on this? When did you file, and when does the SEC have to give you a thumbs up or thumbs down? What's the date for this?
We had filed for these products back in February. I can't speak to exactly when they may be available or what may happen there. But again, I would say they're structured in the same way as index-based leverage and inverse ETFs. Even those, to your point, built for daily reset mechanism. The funds are being re-levered or de-levered on a daily basis, and these are intended to operate in a similar fashion.
Right. So, Dave, Nautic, isn't it 75 days then? Wouldn't they have to give maybe I'm wrong on that, but wouldn't they have to give a response?
We should expect something soon, but then again, the SEC can always kick that can down the road. So those dates are always suggestions. They're never written in stone.
And Will, when did you file?
Similar time. I think we all, the three firms that we're talking about, filed very soon, or very close to each other in that respect. So very soon. I want to come back to a point just on the suitability thing for a second. It may be just interesting to know, how things happen in Europe, and obviously each market is different. But there, most of the time, it's under a suitability regime. These products have been in the market again for a long, long time. We're talking decade plus. Whether you've been able to buy leverage on broad equity indices, on fixed income indices, on individual commodities, even on cryptocurrencies now. So single stocks are just an extension of that sort of ideology. And most of the time, there are brokers or any access to the market, any gatekeeper, if you will, has their own sort of suitability framework around these kind of products. That doesn't mean to say that you're taking a test or anything, but it does mean that you have to go through some extra questions and things to evaluate your suitability before you can buy these products. So I don't want to give the impression that anybody can buy these products, or we shouldn't have that impression that anybody can access, that there's a framework already exists. It's the same in the United States, obviously be different depending on what broker you're talking to. But these are sophisticated products, and there is a framework that already exists around access to those.
Well, Dave, Nautic, Will's right. I mean, we have leveraged products on the S&P for years, but I think there may be something qualitatively different with a single stock issuance. You're not going to, it's unlikely you're going to have a two-time leverage ETF that could influence the underlying S&P, but what about a 2 or 3 times leveraged NVIDIA? If that ETF got sufficiently large, could it make the underlying stock more volatile, for example?
Yeah. So sure, you can imagine a scenario where somehow, 50% of the notional cap weighting of NVIDIA is held by these types of, single leverage or double leverage vehicles that are trading intraday. Yes, I can imagine a world where that could happen. And look, to be fair, there have been moments in time when the volatility levered and inverse funds owned an enormous amount of the available vega in the options market that they were supposedly tracking. So we have had situations like that before. I would point out none of the products that have been filed are on particularly small and illiquid companies. By definition and sort of by design, they're going after the big name above the title type companies like NVIDIA and Amazon and Alphabet. So I'm unworried about it out of the gate, but it's certainly a conversation worth having, right? If these somehow became the default way everybody was trying to get access to these companies, that would be different.
So could Gensler approve this? I'll throw this out to anybody. Could Gensler approve this, but with some kind of qualifications that somehow... I'm just trying to figure out how Gensler can say yes without completely saying yes. I mean, is the option here basically yes or no, or is there some conditional way he could approve something?
There's not really a way to... There's not really a way to conditionally approve a product. They could reject it with comments and say, come back to us when you can establish X, Y, Z. I suspect if they are rejected, they will come with comments about why. I actually think it's more likely that they're just approved, honestly.
Yeah. No, that's a good point. Anybody last word there? Well, you've been a very astute observer of this for many years, since you've already got a product out there. You think, I know you can't handicap this, but you got the last word.
I think that under the current environment, or under the current law, it's a disclosure-based regime. So it's about, does it have the right number of the appropriate disclosures, the right amount of disclosures in the prospectus, and on that basis, that's when something will either go effective or not, and it's fairly black and white. I think if you're talking about something else, a conditional, if you will, Bob, to use your words, I think you're talking about a rule change, and that's a longer process, something that, not beyond the realms of possibility, but I think at the moment, given it's under the 40 Act, we're talking about disclosure, and therefore it's a question of whether there's adequate disclosure or not.
Yeah. This has been a fascinating discussion. And folks, normally on ETF Edge, we have products that you can buy immediately, look at, somebody wants to recommend it. This is a little more theoretical, but I think it's going to be very, very important. I think there is a good chance they'll approve it, providing with tons of disclosure pushed forward. So you're going to hear about this in the next few months. And remember, you heard it first here on ETF Edge. Now, that does it for this week's ETF Edge. My thanks to Dave and Will, and to Dave Noddick. Now, we've asked Dave Noddick to stick around and tell us what he learned at the Exchange ETF conference, which he co-created. That happened just last week, and I was there too. And remember, you can see all of the shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.